Hi, everybody. I wanted to say a few things about China, which has been a lot of the focus over the course of the past month or two because of problems within the real estate market. I wanted to give some color around that, behind those problems, but also why you probably shouldn't be too concerned about it right now. This is a longer term issue rather than something which is going to have a big impact over the course of the near term. First of all, the thing that everyone's concerned about, that is the real estate market. As you can see from the slide here, China's seen a surge in investment in real estate and construction as a proportion of GDP over the course of the past decade. This only goes to 2017, but there will be, it is similar or will be similar going forward until very recently. And you can see that in the past we've had a similar such spike in Spain, which was before the Eurozone crisis and of course before the global financial crisis as well, as a result of the low interest rates from the ECB in the first few years of the Eurozone. The problem here, of course, is that anywhere where you have a glut of investment is that ultimately a lot of that investment goes into bad things, or it gets not misappropriated, but it gets misspent, and therefore money is put into projects which are not necessarily going to come off, not necessarily generate a return, and ultimately there's a tremendous amount of wastage. So we saw this in Japan at the end of the 80s, going into the 90s, and we had probably a 20-year hangover in the property market on the back of that. We had this in the Eurozone, as mentioned, in Spain and some other smaller countries over the course of the period of the noughties. And that is unwinding now, or has mostly unwound now, and we're seeing it in China. And we know that it's come to an end in China, of course, because property prices have started to fall, property companies are going bust, and that is creating a few problems with regard to investment products within China, but also some further concerns regarding the fiscal fortunes of local governments, who over the course of the past decade have largely financed themselves by selling land to development companies. And of course, that process is going to come to a halt. The other big problem we have in China is that the government discovered after the global financial crisis that the easiest way to stimulate the economy is with a surge in bank credit. And of course, that bank credit goes into areas which are the easiest to make some money. And of course, property was that. And we've seen this repeatedly in China over the course of the past decade. This is why, to a large degree, the growth has been so high and so stable, because the government has been able to control growth in that kind of way using this method. Now that's now gone. And with this halt in the property market, we're going to see longer term growth numbers being much lower in China, possibly even negative at times. We'll probably see something approximating a real economic cycle in China, certainly for the first time in most people's investment lives. And that's going to be, that will be interesting to see. Whether this ultimately leads to problems with the economy and with society, we don't know. But what's pretty clear is that in some of these other major economies, the hangover from a property boom has caused larger problems over the medium term. However, in the short term, it's difficult to become too negative. There are problems with investments, but when we look at the economy as a whole, and for something like China, which of course was once regarded as the largest emerging market, and is now of course the second largest economy in the world, still look at something like the external balances to look at the health of the country. And as you can see from this, the axis on the left-hand side is in billions of dollars. China's trade surplus has been close to $1 trillion on a rolling basis over the course of the past year or so. That's large. Of course, as a proportion of the economy, $1 trillion now is a lot less than $200 billion or $400 billion was 10 or 15 years ago. But it means the economy is still generating a tremendous number of dollars. And whether or not you believe these numbers, and there are people who say that the trade surplus is overstated, whether it's 600 or 700 billion or $1 trillion, doesn't really make a great deal of difference. You are seeing an economy that's still competitive, is still exporting strongly, and therefore, when you see people talking about a possibility of a devaluation of the yuan or something like that. I mean, there's no real benefit from that. Dollar yuan going to 8 or 9 might look great in terms of an apocalyptic investment story, but it's not going to do anything for China. China is already competitive. Normally you see devaluations in countries that have current account deficits, trade deficits, and that's just not what we see in China at the moment. Imports are also interesting, and I actually like to look at imports in some detail to see what's going on. The yellow line here is imports overall for China on a year-on-year basis. There are periods when it goes up, there are periods when it goes down. You can see the spike here after the pandemic stimulus. But the problem with this, of course, is that imports are measured in value rather than in volume. And therefore, a significant proportion of these spikes is actually due to value changes rather than volume. You can see right now, imports are contracting at about almost 10% year on year. Again, value is making the value of these imports is making a bigger difference than the volume of these imports. So once we start looking at volumes, and I like looking at iron ore because I see, this is the major ingredient in steel, which is something which is very important for the Chinese economy. You see that iron ore import volumes are actually positive, and they have been positive repeatedly over the course of the past 10 or 15 years. After the financial crisis with the stimulus there, again in the early part of the decade, in the mid part of the decade, and then with the pandemic and the stimulus that comes with that. So it's telling a very different story at the moment. China was reopening, as everybody talked about a year ago and also several months ago, and this is the reopening here. This is what has happened. If we look at other commodities, it's a very similar story. Iron ore is in this chart, but we've also got copper, which is used for building. We've also got crude oil. Again, import volumes. Crude oil import volumes now rising about 25% year on year. It's an extremely healthy growth. And of course, for an economy the size of China's, this is meaningful from a market perspective as well. So the Chinese economy on a cyclical basis is actually not in a particularly bad place right now. In a secular basis, the demise of the housing market is a big problem, and you need to worry about that. But right now, cyclically, it doesn't look too disastrous. What does this mean from an investment perspective? Well, first of all, from my view, the renminbi, the yuan, doesn't need to depreciate much further from here. I don't think there's really a China-specific story in there. I think it's more of a dollar story. Clearly, People's Bank of China will probably cut interest rates more, but that's good. The fact that they can tells you, okay, growth is weak, but also inflation's weak as well. They are not fighting inflation like you're seeing in some of the major developed market economies who are all trying to tighten at the moment. So that's a plus in China's favor. The stock market, of course, is incredibly beaten up. All the concerns at the moment about investment products blowing up on the back of the property crisis and all that kind of stuff. Yeah, that's true. But of course, the property companies have now contracted so much in terms of price that they're not important from a stock index perspective. This is people just selling any Chinese asset, not really thinking about it. So if you are comfortable with tech at a global level, and I think a lot of people are, China's probably worth a look. There are some big tech companies in the country, and the cyclical story in China isn't that bad. And valuation, of course, is, well, certainly a lot cheaper than it's been at any time over the course of the past 2 or 3 years. Thanks very much.